You have 2 weeks. Hey, everybody, you're watching Bull, Boom, Bear, Bust. We're going to tell you who made that dire prediction here. Of course, a lot of other economic financial news to get caught up on. Let's go ahead and get started right here. Well, not only did we have the U.S. downgraded, now we have Moody's cutting deposit ratings at major banks. And this comes after the downgrade of the U.S. here. Moody's rating cut its ratings for deposits at Bank of America, JP Morgan Chase, and Wells Fargo. What does this mean? Sounds interesting, but we've been told for years that the banks were going to be propped up no matter what. So what do they mean by a warning? Moody's cut its rating for deposits at some of the biggest banks. Long-term deposit ratings at these big banks were lowered by one step to AA2, Moody's third highest level. So they're still at a high level. So there's still confidence in the banks. The bond grader also downgraded the senior unsecured debt ratings for some units of Bank of America and the Bank of New York Mellon Corporation, cutting them to AA2 from AA1. Additionally, Moody's cut the long-term counterparty risk ratings for some units of Bank of America, BNY, JP Morgan, State Street, and others, lowering them one notch. It's the latest example of ripples that Moody's sovereign downgrade has generated. The firm stripped the U.S. of top credit rating. Pause right there, folks. This credit rating we've been talking about, it should have been lowered a long time ago. The United States is the world's largest debtor nation. The fact that we even had a AAA rating or A++ is obscene and absurd, both. The downgrade rebounds to companies, investors, and consumers that effectively lend money to banks through providing deposits, entering derivatives trades, or buying unsecured bonds from the units of lenders. They use a lot of fancy terms in there for the mechanisms and for the type of money shuffling that goes on behind the scenes, folks. But the bottom line is, no matter how many loans these banks give out, no matter how many people default on the loans, they're just going to pump more money into the bank if something goes wrong, folks. So all this is just it's just a way to confuse people or make people think that there's a lot of complicated stuff going on. And there is a lot of things going on, but the bottom line, it's really simple. The banks are going to be propped up no matter what. If the banks lose a bunch of money because people can't pay back their loans, they're just going to print the money, add it to the debt, which is coming up on, is it 38 trillion yet? 37 or 38 trillion? Let me just look it up here. Doesn't even matter if it's 37 trillion or 307 trillion. At some point, it just gets to a point where it just doesn't matter. I mean, it can't be paid off, right? But just for giggles, let's take a look here. I'm going over to the debt calculator, the debt clock, and see what we got here. I was going to bring it up on my screen, but now my screen generator, it's not working, so sorry about that. Bring it up here. Then we'll move on to a lot of other news here. Sorry, it's taking a minute here. 36 trillion 876. So we'll be at 37 trillion in looks like just a few short months. And the way that the debt accumulation is accelerating, it could be even faster than that. But then again, does it even matter? Once it gets this high, it's unsustainable, it's unpayable. And, we just have to hope for something big, something massive to come in and just throw this whole thing, tip over the table, so to speak, right? You're losing the card game, you can't win. What do? You tip over the table. Folks, we have the current administration that said they were going to cut spending, cut debt. A bill is being looked at, likely to be introduced. Maybe not, we'll see. But if it is, it's going to add $5 trillion in debt, folks. There appears to be no serious effort in reining in historically elevated deficits, which remains on track to exceed over 6% of the GDP in the coming years, folks. That's what's being reported. Moving on here, people, what else is new? Well, U.S. consumers are really starting to feel the grim reality now that a lot of these loans that didn't have to be paid back for many, many years, almost 5 years, many of these loans now have to be paid back. Student loans, especially. So now this is part of it. JP Morgan came out and they're saying that the recession fear is spiking up to 79%, not just for consumers, but actually markets. Economic sentiment is darkening as money managers and corporate executives struggle to cope with the volatility created by this escalating trade war. Well, it's actually de-escalated. It was over 100% for a while for the country that we get the most stuff imported from. Then they knocked it down to 30% during this 90-day period. It'll likely change in a few weeks. They'll change it to something else. Maybe they'll drop it down. Maybe they'll raise it back up. Who knows? But yeah, the recession fears are going higher. And a big part of that is because a large portion of the population is now going to be massively defaulting. And let's take a look at some of the numbers here. I generated a AI result here for you. Let's go ahead and bring it up so you can look at it and I'll read it to you. As of April, just last month, 9 million student loan borrowers were behind on their payments. More than 5 million of those borrowers haven't made a payment in over a year, folks. 360 days, close to a year. And an additional 4 million borrowers are in late stage delinquencies. That means they're between 91 and 180 days past due on their payments. That's 9.2 million borrowers total. Folks, and it's going to be 10 million very, very soon that'll be in default, because the pattern is right now, the trend is right now that these people are not paying. So it's just a matter of time before the other 4 million are now going to be a year behind, and it's just going to continue to get worse. These people can't pay back their loans for the most part. There may be a few, but we see the numbers getting bigger and bigger and bigger every time we look at it. And how bad? How bad can it get? How many more people? Well, look at the total number of people with student loans. As of a few months ago, it was almost 43 million people. So with 10 million nearing the 1 year default or delinquency, that's about 25%. It's about 1/4 of all borrowers are severely behind. And that is 12% of the overall population that has this debt. 1 in 6 adult has student loan debt. The total debt is $1.6 trillion, folks. So how many of the 42 million are going to be in serious delinquency this year? I think before the end of the year, I think we're going to see this number spike up to it's close to 10 million now. I wouldn't be surprised to see it double, folks. I wouldn't be surprised to see it go up to about 20 million, unless there's another big forgiveness or repayment plan that gets introduced. It seems like the powers that be, the current administration, it seems like they wouldn't want a massive tsunami of people being late on their loans under their watch, because that's going to make them look bad. They'll get the blame, right? But maybe they don't care. Maybe they're bringing this house of cards down on purpose. I mean, what else can you think about it when they're yanking out all these programs, right? And a lot of people would say these programs need to be yanked out because people need to learn how to get by on their own without help, without assistance, without programs, because these programs are supposed to be temporary, but we're seeing them going on for years and years and years. They're finally yanking this away after 5 years, and now economic reality is going to be setting in for a lot of people. All right, moving on here, folks. Jamie Dimon, he's out there. Again, another warning from Jamie Dimon. He issues inflation warning. Is it just me? Are you tired of seeing Jamie Dimon give warnings? Are you just tired of seeing Jamie Dimon? I mean, look at him. He looks like he needs to take a nap. How many billions of dollars do you need before you just retire and go take a nap and rest, right? I thought I looked tired. He looks like he really needs to take a nap. Why do these people, Warren Buffett, same thing. Why do these people just keep going and going and going? You already have tens of billions of dollars. Do you really need to keep investing? Keep going out there, warning people that there's going to be a recession. Actually, they recently lowered their probability from 60% down to 50% as far as this inflation warning, because we saw the tariff deal and the tariff situation decrease. They lowered the tariffs for most countries, down to 30% for 90 days, the 90-day pause. So that made them change it. Is it just me though? Are you tired of seeing these old coots, these old billionaires giving warnings? And he's actually not even that old. I mean, he's going to be 70 next year. Some people think 70 is old. 70 is the new 40. Am I right about that? If you take care of yourself, 70 could be the new 40. It's just weird though that some of these billionaires just keep going. I mean, when do you just say, I'm going to retire, I'm going to go hang out, maybe find your hobby that you couldn't do because you were working full time? I could think of a lot of things I'd rather do besides investing and running a bank, being a CEO of a bank. I would think of a lot funner things to do. But maybe he just works a few hours a week. You've got so much money. You're the CEO. How many hours do you think the CEOs really work? I mean, I'm thinking it's not very much, but who knows? Maybe he's pulling 80 hours and that's why he looks all tired. Right. Anyways, moving on here. In the UK, inflation just surged. So in the US, we have slowing inflation, but in the UK, it just went up to 3.5%. That was higher than expected. And this came off of a 2.8% reading in February and 2.6% in March. So some countries are accelerating on the inflation. And so the U.S., I guess we should be happy that we're in the 2% range still on the inflation number. Folks, bottom line is the money creation is not going to stop. We just saw, a couple months ago that there was a warning that any country that turned away from the U.S. dollar or didn't trade in U.S. dollar was going to face major tariffs, even bigger than what they're seeing now. So that was a way of saying that the dollar is going to be reinforced, but we're still seeing a loss of confidence in the dollar, and countries are now dumping U.S. debt, and so we're starting to see rates go up a little bit. And where does that end? Are we going to see a massive dumping of U.S. dollars, or are these countries too afraid that they're going to get punished with these tariffs, right? So a lot of interesting things that we're going to watch play out here. Let me know what you think about any of this down below. Jamie Dimon's prediction. Are you tired of him like me? What else did we talk about? The recession fears spiking up to 79%. That's a multi-year high in that. Oh, one more thing before we wrap it up here. We've got this warning in 2 weeks. What's going to happen in 2 weeks? Well, we've got this warning out there from Jim Rickards. And he says this will affect us in 2 weeks. At least that's what they're reporting over at BIN. And what's going to happen in 2 weeks? Basically, he says the central banks are going to blow up the economy, right? But do you really think that's true? Or is it just an eye-catching headline? And they're giving us a quote out of this report here. Quote, central banks are about to collapse the economy. Unquote. So what do you think about that? I try not to put timelines on things. I say always be ready, always be prepared. Have cash ready for a downturn, but also look for investment opportunities as we continue to go through this economic insanity, folks. Let me know. Thanks, everybody. Keep stacking. Bye for now. Peace.